Socks and Tops, ignore value-added tax first. Socks and Tops is a company situated in the World Triangle. The entity was registered in May 2016 and adopted the 28 February financial year end. SCFA mainly specializes in the distribution of socks and t-shirts throughout South Africa. The entity is managed by 3 directors. Each director specializes in his or her field of expertise, which greatly attributes greatly to the success of the company. All the staff members feel that they are part of the entity and they share the vision and mission of the company. Great. Their contributions and suggestions to improve the entity are always taken seriously. SCFA bought a piece of land in the industrial area of Vanderbilt Park, and the registration date, as printed by the Deeds Office on the proof of registration, is 26 May 2017. Now, before we continue, let's quickly see where are we. Now, the easiest is to check that in the required part of the question. What do we have to do? We have to prepare the IAS 16 property, plant and equipment note to the statement of financial position as at 28 February 2019. So many moons ago, we have acquired this piece of land. Now, guys, under the videos right in the beginning, after we've done the slides, I've actually loaded up a short video on revaluation of non-current assets. Make sure, go back to that video first, watch that, it's only a 4-minute video or something like that. Watch that video first before you're going to continue with this question. Now the required part is the IAS 16 note. So once you see that in a question, immediately you go and you write down the skeleton of the IAS 16 note. Now here you see that we have land. And then if you actually read through the question first before you start answering the question, which you should do, you see that here they have machines, embroidery machines, so that's a different class of asset. Then they have aircraft, so that's a different class of asset. And the last thing is vehicles. So you know that you have all those classes of assets in your IAS 16 note. Good, coming back to the land. The purchase of the land was financed in full, important words, by a loan that was taken out from Namba Bank for 1,405,000. So if that was the loan amount and the loan amount was for the full purchase price of the land, it means that the cost price of the land was also 1,405. This loan amount also included an amount borrowed for the transfer duty, which amounted to 2,500. It includes that amount. It should include that amount because it's a compulsory cost that I have to pay whenever I buy land. So it's already included in the 1,405. I'm not going to add it again. The ultimate goal for buying the land is for erecting a warehouse on the property. Vanderbilt Park is close to our Tambo Airport and the busy Gauteng market, which makes the distribution of orders very easy. The legal firm involved with the deeds registration released all the funds to the various parties involved at the date of registration. A sworn appraiser appraised the land to be worth 1,650 at 28 February 2019, and the company decided to apply the revaluation model on land. You have to have that as a policy before you may revalue any of your non-current assets. So that is now part of the accounting policy, and therefore they are allowed to revalue that land. So at the beginning of the year, we will start off with land cost 1,405. There is no accumulated depreciation on land. Why not? Usually the value of land increases over time, and very seldomly it decreases over time. Buildings, though, that value of a building should be depreciated over time because there's wear and tear on a building. And if you do not maintain a building and you do not look after a building, it for sure is going to lose value over time. But land is something different. We do not depreciate land. Good. We also saw that that land was actually valued for an amount of 1,650 at the end of the year. So we would like to see that as our closing balance. We need a debit on the land account though, then of 245,000, and the counter leg of this entry will debit land and credit our revaluation surplus or revaluation reserve account. And the revaluation surplus or reserve account, the credit side of the entry, that forms part of equity. Also very important, you have to tell me where the land is situated, and if I don't give you that particulars, You have to assume any particulars that you want to, but you have to give me the location of the land and the buildings if they had buildings as well. Good. Then we are here at the embroidery machine. Many orders received from schools and universities require the emblem of the institution must appear on the socks and tops ordered. Details of the machine can be summarized as follows. Purchase price paid in cash on 1 July 2018, and that was 160,000. And then we had to pay installation cost on 14 July for 18,000. And then we paid training cost for our employees by 31 July 2018, and you know that you are not allowed to capitalize as part of the cost price of a non-current asset any administration or administrative related cost. Also, specifically, IAS 16 excludes training costs of staff. So the actual cost price of this asset is then 178,000 Rand. The date of the first order was 1 September, but the machine was ready to be used on 31 July 2018. So we are writing off depreciation on a non-current asset from the date that we were able to use that asset for the purpose that it was acquired for. In this case, 31 July. The embroidery machine will be depreciated over 3 years, taking into account a residual value of 28,000 Rand. Depreciation is provided for by applying the straight line method. So let's quickly work out the depreciation on that machine. The total cost price we said is going to be 178,000 Rand. 160 and the 18, those two together. The estimated residual value is going to be 28,000. We're going to depreciate it over a 3-year period, and we're going to use that from the 1st of December up to the end of February for a period of 7 months. From the 31st of July, sorry, from the 31st of July up to the end of February, it's a period of 7 months, and that gives us 29,167 Rand worth of depreciation. So let's complete for the next one we go on, and we're going to go to the aircraft. So let's complete our IAS 16 note for machinery. There was nothing in the beginning of the year. Additions at cost price then, 178,000 Rand. Additions at cost, 178,000, 160 and the 18. Our depreciation for the year, we've worked that out, 29,167. 29,167, and at the end of the year, the cost price of our machinery will be the 178, accumulated depreciation 29,167, and the carry value 148,333. Good. During November, the directors got together for a strategic meeting. Clients have been asking for quicker deliveries of items ordered. Mr. Bram Fly, one of the directors, suggested that the entity acquire light aircraft. He argued that he himself has a license to fly small aircrafts and that he's willing to assist in the urgent delivery of items. The small aircraft was purchased on 1 December 2018 and paid for in cash and was available for use on the same date. It was decided that due to the different estimated useful lifetimes of the different components of the aircraft, each component will be recorded and depreciated separately. So in our general ledger, we're going to have for each and every component a cost price account and accumulated depreciation account. However, in the IAS 16 note, we're only going to have one column for aircraft. So you will have to add all the particulars of the components together when you complete the aircraft note. If you have shown those components separately on the IAS 16 note, you would not have received one single mark for all your effort and all your calculations that you've done. Right, let's check out now the components. Remember that we were able to start using it on the 1st of December 2018. The first part of the aircraft is the body of the aircraft. The cost associated with that was 200,000. Useful life 5 years, estimated residual value 20,000, and it is going to be depreciated on the straight line method. So 200,000 less 20,000 divided by 5 multiplied by 3 months. I've used that asset for 3 months. See here, the body. And that gives us then depreciation of 9,000 Rand. There's the calculation. The next component is the engine. The engine, cost price 45,000, useful life is 50,000 flight hours. We're going to use the unit of production method, and the estimated residual value equals 5,000. So our depreciation for the year is going to be 45,000 less 5,000 divided by 50,000. That's going to give us a rate per flight hour, and then they tell us here that we have traveled 14,000 flight hours during the financial year, so multiplied by the 14,000. 45 less 5 divided by 50,000, total capacity, multiplied by 14,000, 11,200. The last component is the interior of the aircraft. Cost was 22,000, useful life 20% per annum on the diminishing balance method, and there is an estimated residual value of 2,000 Rand. So our depreciation is going to be 22,000. We ignore for depreciation calculation purposes the estimated residual value when we work on the diminishing balance method. So it's only going to be 22,000 multiplied by 20% for a period of 3 months, and that gives us 1,100. Then we add all these little components together, and we only have one depreciation charge that's going to our IAS 16 note, and that is in the depreciation 21,300. Additions at cost price, and here we're going to add the cost price of the assets, the 200 plus the 45 plus the 22, and that gives us total cost price of 267,000. There was nothing in the beginning of the year, so at the end of the year we have an aircraft with a cost price of 267 and a accumulated depreciation of 21,300. So that in total then gives us 148,833. Great. The last class of asset that we have is that we have vehicles. STFA acquired a new fleet of vehicles on 1 June 2016 at an all-inclusive price of 1,050,000, which comprised of 4 delivery vehicles. The estimated residual value per vehicle, one vehicle, was deemed to be 12,500 Rand. A straight line method was applied for providing for depreciation, and the estimated useful lifetime of the vehicles was estimated at 6 years. Good, the financial accountant of STFA already calculated and recorded the depreciation on the above mentioned vehicles. The financial director did some research on delivery vehicles and found that the maximum amount that will be received on a delivery vehicle after being used for 6 years would have been 7,500 Rand. Previously, we've worked on 12,500 Rand. He also established that on average, after 5 years, a delivery vehicle with the same make and model traveled more or less 300,000 kilometers. He approved that the vehicles must rather be depreciated over 5 years, and that the residual value per vehicle should be 7,500 Rand. The reallocation method should be used in order to account for the change in estimate. And then he gives you the following calculations. He says that the cost price of those vehicles that he gave you on top as well was 1,050. And here you worked out your depreciation charge for 2017. It says I've used it for 9 months in 2017, and my depreciation was 125,000. I've used those vehicles for the full 2018 financial year, and my accumulated depreciation for that year increased with that further 166,667. So our carrying value of these vehicles at the beginning of the current year, 758,333. And then there was the change in estimate. We have to apply the reallocation method, so therefore our starting point is our carry value at the beginning of the year, which he gave us 758,333. we have to apply the new estimates on the carry value as at the beginning of the year, 758333. So our depreciable value is going to be the 758333 less our estimated residual value, which is 7,500 multiplied by 4. We have 4 vehicles. And that we're going to divide by the remaining lifetime of the asset. Now it says that we have to use a total lifetime of 5 years. How many years has gone past? Well, we've used that asset for 9 months in 2017, and we've used that asset for 12 months in 2018. So 12 plus 9 gives me a total of 21 months that we've used the asset. It says that the total lifetime of the assets that we should use is 5 years. So 5 years equals 60 months. We've already used 21 of that 60 months, so there is a remaining lifetime of the asset of 39 months. Carry value at the beginning of the year, 758333, less our estimated residual value is 7,500 times 4 gives us 30,000. That gives us a depreciable value of 728,333. Our current year's depreciation is then our 728,333 divided by the remaining lifetime of the asset, so divided by 39 multiplied by 12, because we work with months, 39 months. And that gives us then 224,102 depreciation for the year. So on our IAS 16 note, under depreciation, that line, 224,102. The 1050 and the 291667, they gave it to us. It's 1050. Those two together gives me the 291667. So what is our carry value at the end of the year? The cost price stays the same, 1050. Accumulated depreciation is going to be the 291667 plus the 224,102, which gives us in total 515769, and we're going to end up with a closing carry value on the vehicles of 534,231.